Please join me in welcoming our next speaker, Sonam Srivastava. She's a quantitative investment manager with more than 9 years of experience in the field of quant investing and trading. And she is actually featured among the top 100 women in finance by AIWMI. She is a graduate of IIT Kanpur and she has a master's in financial engineering from World Quant University. She has worked in her previous roles as portfolio manager at HSBC and QPlum and as an algo trader at Edel and Forefront Capital. She is now the founder and CEO of Wright Research, which offers a lot of very, very innovative and interesting solutions on the factor side through various different investment mechanisms, small cases being one of those. So she's here to talk about how the low volatility strategy busts the myth that low risk equals low returns. So over to you, Sonam. Sonam, I think you're on mute.
Awesome. Yeah, so thanks a lot for the introduction. I listened to your talk and I really liked the introduction that you give to factor investing and to factors in general. So what I would try to do in my presentation is, showcase, like I said, a little bit about myth busting and showcase what are the actual behavior reasons for which low volatility sort of works in the market, right? So I'll try to keep it a little bit more fun and slightly a little casual in this presentation. Before we sort of start with this, I'll try to I'll give you a little bit of an introduction on, you talked about Wright Research and my background. I'll give you a little introduction on Wright Research. So we are, investment advisors who sort of create these factor-driven strategies for the retail audiences. And we are doing this on platforms like Smallcase, etc. And a lot of people, like you said, I've worked in larger organizations before this and now doing it for the, openly for the larger market. I see so much interest coming on into factor strategy and quant strategies over the last 2 years, which is really, really exciting. And, that's why this particular opportunity with Motilal Oswal, where you guys are talking about factor investing, is so interesting for me. So what I'm going to talk about in this particular presentation is, busting the myth that, low risk means low returns, right? So if you have actually read any of the financial models, right? If you have a little bit of a quantitative background and, or if you have done any sort of financial modeling, you would see that a lot of your financial models, a lot of your investment models have this assumption that, high risk equals high returns, right? So the most famous of them being the capital model, right? The capital asset pricing model, which is like the basis of most of the asset pricing models. All of these have these assumptions that, high risk means high returns. So the more risk you take, the more returns you'll get. But what is not very well known is ever since this particular model was published, ever since the capital model was published, immediately after that, people busted the myth and, there were various empirical studies that showed that actually, high risk does not mean high returns. Sometimes low risk gives you better returns. And the low volatility factor or the low volatility anomaly, what it's trying to do is actually give you, it's trying to create superior returns at the same, at a lower level of risk for the investor, right? So it gives you a lower return of risk compared to the market and gives you a return which matches the market, which makes it, a better strategy in the long run. So essentially, if you actually study the low volatility anomaly, you will find out that actually low risk gives you a much competitive return, and which actually in the last presentation you had, shown it really well. So I think you also mentioned that low volatility is nothing new. Low volatility is something that even Warren Buffett is supposed to follow. He does not invest into, very high risk, very high value stocks. He goes for undervalued stocks. He goes for stocks that have low volatility. And it's a famous quote by Warren Buffett that says that volatility is not measured by risk, right? In all of financial models where we say that, risk or the standard deviation is what volatility is. Volatility is a much bigger thing, right? It involves forecasting the future, it involves knowing a lot of other things apart from just the price standard deviation, right? So volatility actually comes from not knowing what you're doing when you are investing. In this particular presentation, what I will try to do now is I'll try to, showcase some of the salient factors of low volatility investing. And then I'll take you through the behavioral region. I think that's the most important aspect, and that's the most interesting aspect of this, right? To understand why does low volatility actually work. Because if there is a well-known factor, if there is a well-known opportunity in the market, it usually gets arbitraged away, right? If more and more people will know about it, it should eventually go away. Why should, one particular opportunity continue to perform over the years? So we'll try to understand that and try to, bust some myths around low volatility. So the first thing is that why does low volatility actually work is that a low volatility strategy, because it is focusing on picking stocks that have lower volatility, it inherently, takes away, it avoids the bad stocks, right? So any stocks that have, huge risk or huge, causes for drawdowns in the future, they will be skipped because this particular strategy is picking up all the low volatility stable stocks, right? So that is why this particular strategy tends to do well. So if in this particular chart that I picked up from a research piece, you'll see that a low volatility strategy, which is including stocks that are in the lowest quantile in terms of volatility, does much better than stocks that are in the highest quantile, right, in terms of their risk. So this immediately, shows that the assumption that high risk is equal to high return is not true in the simplest sense. Second thing that I want to show to you is why does low volatility do well is because volatility is persistent over time. So any particular stock that has been showing a low volatility in a bull market will continue to give you a low volatility even in a bear market, right? If you look at this chart here, you will see that I have a high risk stock and I have a low risk stock. So this high risk stock, it gives you a 25% return in year one, which is very favorable here. But in the year two, it again falls 15%, right? And again, it rises 25%, then falls 15%. So this makes it highly volatile. It gives you good flavor in, good markets, but it underperforms when the markets are volatile. Whereas if you look at the stock B, which is a low volatility stock, you'll see that this one gives you only a 15% return. So it is underperforming stock A during, the bull times, but in the bearish times, it has given outperformance of 10% because it doesn't fall that much, right? So over the long run, if you do the average return, you will see both of them have given a similar average return, but the CAGR of the low volatility stock is better than the high volatility stock, right? So this inherent persistence of volatility, right? Volatility tends to continue over time. This leads to outperforming of the low volatility strategy. Now, the third thing that I want to showcase to you, which I think the previous presenter also showed, is that a low volatility strategy also has low drawdowns. So if you compare this particular strategy with all the popular strategies like a price momentum or a value or even the market indices, you see that at the worst time of the crisis, right? Be it the internet bubble, be it the global financial crisis, be it the European debt crisis, or any of the large crises that has happened in the market, this particular strategy tends to do better than most of the other factors. I mean, consistently is one of the best performing factors among all the other factors especially during crisis period, especially during when the markets are going through some sort of instability. So so this is also a very salient factor, salient feature of low volatility factor that makes it extremely attractive for people. And then, if you are an institutional investor, or if you have, a large corpus to invest, you are looking to diversify your exposure across various things, right? Eventually, you will find that, a price momentum strategy tends to have a high correlation with the market, right? It does well when the market is doing well, but it also tanks when the market is not doing well, right? Similarly, small caps also have a high beta, and, your value strategy might have a negative beta. So the low volatility strategy here is giving you uncorrelated exposure to these stocks. So it is one strategy that has low correlation to all the other factors, right? So it is, when we talk about factors in the market, when we talk about, things that are differentiating or, describing the market, you'll see that low volatility is one such component which is giving you, good returns, consistent returns, but at a low correlation with the others, right? So it is a good factor to add into your portfolio because, it will give you consistent return in volatile times. Plus, it is not, taking away from any other factor. It is, it will enhance your diversification because it has low correlation with the other factors. And then finally, the thing is that the low volatility factors outperform across markets, right? So it's not just that, it is something that is unique to the US market or the European market or to emerging markets. If you look at this chart over here, you'll see that the low volatility factor actually outperforms in all, global markets, in all developed markets, and even in emerging markets. So if you look at Asia, if you look at emerging markets, everywhere you see that in the long term, the low volatility factor has actually outperformed the larger, high volatility factors at least by a huge margin, right? So this is actually it was shown in the last presentation also, that low volatility is actually a very, very good strategy for people to invest into, right? Now we come to the interesting part, which is, we understood that, okay, it's a good investing strategy. It is, something that is consistently doing well. But why is it consistently doing well, right? If there is a mispricing in the market, if there is an anomaly in the market, then usually, people just jump on it and, they diversify it away or they arbitrage it away, right? If you see that, suddenly one particular stock is being sold at a price which is less than its value, people will jump on it and buy it, right? So why is this particular anomaly continuing across time, right? Which makes it really interesting and which is why we need to understand the behavioral reason behind the low volatility strategy, right? So the behavioral explanation of a low volatility strategy is, there are various behavioral reasons that explain the low volatility strategy. The first thing is that, some investors look at stocks like lottery tickets, right? So when you give them an opportunity that, okay, there's a 100 rupee thing which might go to 110 or might give you a loss of 10 rupees, right? It might go to 90 or it might go to 110. Nobody is that attracted to that. It's okay. It's a small profit and loss. But if you give them an opportunity, that your 100 rupees might go to, 50, or they might go to 500, right? It's a amazing opportunity. So people start valuing that more, right? Like you value the lottery ticket. If a lottery guy says that, you will make your 100 rupees will go to a lakh, then you will go and, pay some money to buy that lottery ticket, right? So that is the philosophy of some of the investors who buy into high risk strategies. They inherently don't look at, arbitraging away the low volatility stocks because they have this mentality of, doing a lottery because, there's certain stocks like an Apple, not like an Apple, but let's say some overvalued stock like in the like the FANG stocks might suddenly give them crazy returns, and they sort of forget about other low volatility stock, and they're not going away to participate in that particular anomaly. The second reason why low volatility might work is that we associate, like our brains, we are like investors are not rational, right? Investors inherently are irrational, right? So we form our own representativeness in our head, right? So what we see is that, okay, historically, a tech stock has done really well, or historically, somebody from this promoter has done really, really well, right? So we form that representative in our head, and once we see, or maybe let's say a new age company typically does really well, right? So we form that philosophy and we forget about everything else that goes behind it. Might be overvalued, it might not have some good fundamentals, it might be very volatile, right? We forget about those things and we focus on the set or group that is in our head, and we pay a huge amount of money for it. We forget about the low volatility stocks, which is why the low volatility anomaly continues to steadily outperform. The third behavioral bias that that investors have is that investors are generally overconfident, right, about beating the benchmark. They want to forecast the future, right? They want to outperform the market, right? So if you have a low volatility stock which will give you a stable sort of a return, which it's very predictable, so it's not interesting for people, right? They want to find out the next big thing. They want to find out something that's going to really outperform and give a boost to their confidence, right, in their ability to stock check. So they ignore the low volatility stocks and they go for the high volatility stocks, which is why the opportunity in low volatility stocks continues to go by. The second explanation of this low volatility anomaly is that investors, they have their own constraints, right? So one thing being that these low volatility stocks, even institutional investors, right? I mean, there are huge funds out there. Why are they not betting on low volatility? Why are they betting on these large cap stocks, right? Or not the large cap stocks, but the high volatility stocks, the high beta stocks. Right? So one explanation for that is that because these high volatility stocks, right, which are very highly volatile, the small cap stocks, they cannot be shorted. There's a leverage constraint and things like that. So it is difficult for people to actually short high volatility and go for those, which makes the people not being able to participate in the low volatility anomaly. Second thing is that a lot of investors, right? There's a lot of investors who do only passive investing, right? There's a lot of investors who do passive. If they do active investing, they have a tracking error constraint, right? Their funds are being evaluated by the information ratio, where tracking error plays a very, very important part. So if you're tracking a passive benchmark and that passive benchmark does not have a representation of low volatility stocks, then obviously you're going to ignore it. If all the large cap stocks that have really grown with high volatility or with high momentum are suddenly paused, because it's market cap rated, so your passive strategy will suddenly have those stocks having representation, and the low volatility stocks, they might not get high representation, right? So low volatility stock will continue to do well, even as an anomaly that is not arbitraged away, because people are not focusing on that one. They're focusing on the stocks that have representation in the passive index. The third reason is that a lot of managers, like even like me, right? Like we try to focus on what people want, right? People like high momentum stock. People like these high beta themes like innovation and things like that. We tend to focus and bring that out to people. We sort of ignore the low volatility opportunity. We let it be, and that's why the anomaly continues, right? That's why it's not arbitraged away. That's why it continues to stick in the market. So that is, this is what I found really interesting while studying this anomaly for this particular presentation. The low volatility is the anomaly continues to outperform, and there is a highly explainable reason in the investor psyche, as well as the constraints that various managers have. Now talking about the index methodology, how do you create a low volatility index? How do people create a low volatility strategy? So there are various methods of doing that. I think the S&P publishes a particular low volatility index, where what they do is they go with the top 500 stocks in the universe. They look at the volatility or standard deviation over the last 252 days or 1 year in terms of working days, and then they ran the stocks based on the historical volatility, right? And then what the S&P does is that they take the 100 least volatile stocks and they weigh it using inverse volatility, right? So the idea is that they're picking the low volatility stocks, and even among them, they are giving the highest weight to the stock that has the lowest volatility, which is really interesting. MSCI has a different methodology, right? They might be picking a smaller set of stocks, or they might be, focusing on different type of weighing, right? So I think S&P 500 they does inverse volatility weighing. Some might do equal weighted weighing, right? Coming back to the Indian market, in Indian market there are a couple of actually low volatility indices that are published by the NSE. This is your Nifty 100 low volatility 30 index. How this one is made is that they again the methodology again is that they look at their universe. I think NSE focus only on the top 100 stocks by market capitalization. They rank them by the 1 year volatility, and then they pick the top 30 stocks based on the lowest volatility that those might have. They will rebalance it on a quarterly basis, depending, they don't rebalance it very actively. They rebalance it on a quarterly basis, and they have, various well-defined methods through which a stock can come and go that you can go and find on the NSE website as well. And looking at this is a very good strategy that has very stably and consistently performed in the market, right, since 2005, where NSE has sort of published this particular strategy, right? So we at Wright Research, what we also do is we create our own low volatility basket, and the idea for us is that we try to explore as many factors that we can, right? We are not very much married to the MSCI definition or to the NSE definition. We try to be a little bit nimble and find out other interesting stuff that we're able to find. So the low volatility strategy that we include in our multi-factor portfolio is we look at two types of low volatility, right? We look at a long-term low volatility strategy where we're looking at 1 year volatility in stocks. And then we also look at a short-term low volatility strategy where we're only looking at like a month worth of volatility. We're not looking at long-term volatility, right? And you see here, again, these are slightly more active than the NSE index. We rebalance monthly, and we don't use, simple weighing and ranking and going with that. We use our own portfolio optimization methods, and which are slightly, proprietary to us while creating these baskets. And what we see is that both the short and the long-term low volatility strategy for us has consistently beaten the index, the Nifty 50 index, over the long term. So in this chart, which is from 2013 to now, you see that the long-term volatility strategy has given almost 21% CAGR compared to 13.3 by the Nifty, and short-term has even given better CAGR. If you look at the risk of the portfolio, you see that both our low volatility strategies have a lower risk compared to the Nifty. And the drawdown for the low volatility strategy is, I think, long-term volatility strategy is very, very interesting here, because this is a pure stock portfolio, right? It doesn't have any other asset class, right? It never went to cash, right? It is all pure equity. So even during the 2020 crash, this basket of stocks which are low volatility, they only gave a 20% drawdown when the overall market gives you a 37% drawdown, which is really interesting, right? Because in that massive crash, even then, these stocks on their own, saved so much on the drawdown. Now looking at a couple of risk scenarios to understand, how does this particular strategy behave when there's risk in the market. So picked up here the 2020 crash, right? How does this particular strategy behave in the 2020 crash? You will see, like I said, when the Nifty crashed around, 37%, our long-term volatility strategy only crashed 20%, and then very quickly it recovered, right? Which is, I think, very interesting, and this is what adds to the outperformance that this particular strategy has. Our Nifty low volatility and even the short-term low volatility strategy that we have also gave a lower drawdown than the index during this extreme crisis time that we had in March 2020. Talking about another risk scenario that we recently saw, which was in 2016-17, which was around the demonetization crisis, right? Which was again a big drawdown that has happened in the India market, which was more than 10%. We see that during that time, our long-term volatility strategy tend to give a lower drawdown compared to the Nifty, whereas a short-term low volatility strategy gave a higher drawdown, which might be possible because short-term volatility strategy is only looking at a 1 month volatility, that it is slightly unaware compared to or because risk over long term might be more persistent compared to risk over shorter term, right? So which is why you might see that the short-term volatility strategy sometimes has a higher risk compared to a long-term volatility strategy. And the indices that we saw with the S&P 500, with the MSCI, and with the Nifty or NSE, all of them use the long-term low volatility factors. Now talking about the risk, right? So obviously we are betting on low risk. So all the time, like in all the years that I have sort of picked up here, around 9 years, in each year both of our strategies have a lower risk compared to the index, which is expected because we are picking up these low volatility stocks. And if you look at the risk adjusted returns, right, you'll see that 8 out of the 9 years, right, in 8 out of the 9 years, the low volatility strategies have outperformed the Nifty index, which is extremely interesting because that's what as investors we're trying to do. We're trying to beat the benchmark on a risk adjusted return basis. So you will see that in 8 out of the last 9 years, our low volatility strategies have beaten the Nifty index in the risk adjusted return basis. Now talking about a little bit more about what goes inside a low volatility strategy, right? What types of sectors get representation for a low volatility strategy? So for us, so if you look inside the low volatility portfolio, you will see that, it is as expected, right? FMCG sectors, which typically don't go up that much, they don't go down that much. They will have a large representation in this particular strategy. IT index, which is also low volatility, will have a high weightage. We see financial services, we see healthcare also getting good representation in this particular index. And all the high volatility sectors like construction, chemicals, power, oil and gas, etc., will get very, very low representation in this particular index. And obviously, if you look at the breakup by market capitalization, you will see that this particular strategy will tend to have the large cap stocks compared to the small cap stocks, because small cap stocks tend to be more volatile than large cap stocks. Now looking at the composition in terms of what all stocks are present in this particular index, so obviously you would have guessed that it contains all your FMCG names, Nestle, Dabur, Britannia, HUL, etc. Infosys pieces also form a large part. The HSBC Bank, HSBC Life, with a very stable financial services stocks, also form a large portion of this particular portfolio. So this is how the stocks sort of look like for this particular portfolio. So that brings me towards the end of my particular session. I think I have run up a little bit quickly, so I'll probably go through some of the interesting parts of the presentation if you guys want.
Up to you. So if you feel that you want to spend some more time on any of the slides, that's okay. Or we can also go to the Q&A.
Yeah, we can do the Q&A if you think we can go there. Yeah.
All right, great. So thanks, Sonam, for the nice presentation. A lot of concepts covered and a lot of concepts clarified. I think the first question I have is, do you have a small case which only focuses on the low volatility factor that you're offering to investors at yet?
No, we don't. So we include low volatility in our multi-factor portfolio, but we don't have a single low volatility strategy.
Okay, got it. So there are quite a few questions which have come in. So I will start reading out some of these questions. So one of the interesting ones that I saw was, how does a low volatility factor perform in a sideways market and in an inflationary market?
Mm-hmm. So how does a low volatility perform in a sideways market? So like I said, a low volatility tends to give you small returns which are consistent, right? Which is what differentiates it, right? It will not give you a massive return during a bull market, but it will not give you a massive return during a drawdown. So in a sideways market, you can expect, probably low returns on a positive side, because you've included sectors like FMCG, sectors like utilities, which tend to do decently well during sideways market.
Right. So follow-on question to that would be, so like you said, FMCG companies are a large part of the strategy. And these companies are also fairly overvalued. So as inflation goes up, do you think that the strategy will continue to offer the kind of superior downside protection performance, or do you think some characteristic change may happen with the strategy?
So you mean when the market goes to a drawdown?
Yeah. So because these are overvalued, and if we foresee inflationary periods, then those inflationary periods hit us, which leads to some correction in the market. Does the low volatility factor continue its performance, or should one expect some sort of reversal in performance in that short time frame?
Yeah, so you're saying that the FMCG sector has become overvalued.
So yeah, exactly.
Okay. Yeah, so I think so if you look at the recent performance of the low volatility index, I think you might be tracking it. So it hasn't done extremely well, right? Because I think that's because the FMCG sector has gone through some trouble, right? Because of the rural demand slowing down, and there's a lot of inflationary pressure in the market, right? So I think things like that might be, but those are, I think, transitory reasons, right? Those are, not permanent reasons, right? A slowdown in global demand, something like that, is not something that is permanent, right? So while that might be happening in a specific case of India right now, in the long term, we can sort of expect the low volatility to be robust during market crash, or the periods of market volatility. So yeah, it's a very interesting thing that right now we see that FMCG is underperforming even during the volatile time, because we are in a unique situation, right, where there is a huge inflationary pressure and rural demand is dying down, plus there are global headwinds, right? So even a sector like FMCG is facing some pressure.
Indeed, I think that's a very valid point, and I think one of the other questions was also related to the recent underperformance of the low volatility factor, but I think you covered that. Given that these set of circumstances are unique, and so will be the case with every other set of circumstances, but the key is to remain invested over a period of time. So I think point taken and very, very valid.
Right. One of the something like the COVID crisis and the Ukraine crisis is not something that hopefully will not persist over decades, right?
Exactly. We hope not. Right. Yeah. So one very interesting question is, should we combine low volatility and momentum? And if yes, how do you think we should do that?
So I think people do that, right? People do combine low volatility and momentum. So there are like n number of ways of doing it. So, you can create a portfolio using momentum factor, and you can weigh your momentum stocks based on their volatility, right? That is one way of doing it. You can, you can just do a 50-50 allocation to momentum or volatility if you wanted, right? Or you can tactically shift your allocation between a momentum and a low volatility ETF if you want, right? Or, your portfolio weighing criteria could be a sum of the portfolio's momentum value and its volatility value, right? In a certain way. So there are various ways of doing it. So I think everybody has their own approach of sort of following up on these things. Yeah.
Right. One interesting question that also came our way is, and I think you explained this in a lot of detail during a presentation, but perhaps it's because of the amount of importance this feature has, or this section has, maybe we want to take it again. The question is, if the low volatility strategy becomes popular, if everyone starts using this strategy, then don't you think the alpha will start shrinking? Don't you think the alpha will disappear over a period of time? I think you touched, actually not even touched, you
Yeah,
explained it in great detail, but
yeah,
maybe
yeah,
worthwhile
yeah.
to,
So
spend some more time.
yeah, so I like that part of the presentation the best, right? Like why is it not being eaten away, right? Why is, if low volatility works, then why is it not going away, right? So
Exactly.
why is it not going away is, I mean, you and me can even understand that, when the market is giving you this crazy outperformance, then all of us went towards momentum, right? Nobody was saying that, let's go for low volatility. So it is an investor behavior that, when you're seeing a 60% return a year, right, in the market or in the high volatility stock, then you will definitely go and, like, a lot of us will go and shift towards those, and we'll see, okay, uh, and then we'll ignore the novelty or anomaly, right? And we'll let it be. So it is not being arbitraged away. There's not sufficient amount of focus that is going to that particular strategy that, let it get arbitraged away. Obviously, when sort of the markets become volatile, right? When the market tends to underperform, right? When the market is giving low returns, at that point in time, a lot of us start focusing on low volatility. Even in a multi-factor where we are trying to be tactical among factors, we shift a focus a little bit over towards volatility, right? So that is what happens. And that time you see low volatility is again outperforming the low volatility which was underperforming momentum during, bullish times is outperforming during those times, right? And uh, and another reason that I sort of touched upon was that, there are a lot of constraints for, large fund managers, right? They have to maintain certain tracking errors, and they have to follow the index a fair bit, right? So they cannot just say, okay, I'm going to leave that and do low volatility today, until unless they are a low volatility manager.
Right. So one of the questions is, so there are quite a few index funds that are out there, which are available to the investor, but there are some differences in these funds. So each fund is maybe tracking a different index. So how does one choose if they are completely sold on the idea of investing in a low volatility fund? Which fund should they invest in? Is there any good way to think about this?
So I mean, so there might be a few, funds that are tracking the low volatility index. You should, look at their, methodology. If they're just following, if they're just tracking the Nifty low vol index, right? Then you can just look at the tracking error, and that's the way to track a index fund. If you have, somebody who is, giving a low volatility strategy that might have tracking error, in its definition, then you evaluate its performance relative to the low volatility index and see, why it is outperforming, but yeah, obviously, if you are evaluating a low volatility strategy, then you have to compare it with the Nifty low volatility index. You cannot compare it with any other benchmark.
Right. No, I think the question is also, Nifty also provides a low volatility index. S&P also provides a low volatility index. So which one to choose? So is there a good way to think about it, or doesn't it matter as much? That may be the question.
So if you talk about just the indices, right? I think, I like, so in the S&P methodology, they were weighing it based on inverse of the volatility, right? Whereas the Nifty was just tracking stocks and it's picking up. So I like that approach better. There is no, there's no way to say, which one is better in terms of an index. I think the index provider's motivation is to be, simple and replicable, right? They don't want, they're not trying to bring in extra alpha or anything like that. Right? They just want to be a trackable index, right? Which is representing a particular anomaly. Right? So I think picking either of these benchmarks might be good enough. You might need to, evaluate them for their long-term return and risk patterns to make a call.
Right. How suitable do you think a low volatility fund is for someone who is a retiree?
See, I think it will be, talking about a retiree, it is, a retiree definitely has a risk profile which favors debt more than equities, right? But if you are going to pick up equity to be a small component of your portfolio, I think low volatility would be a suitable strategy for you, because, it will your drawdowns will be much lesser, and you will see a much more consistent appreciation of your capital compared to, any high risk fund, right? So a retiree will be much more comfortable of putting his equity corpus in a low volatility strategy compared to even an index fund. Yeah.
So one more question which we got in just now is there a scenario that the low volatility strategy particularly does well in emerging markets as compared to developed markets, or is that not the case? If you have seen that.
So, I mean, see, with our, the particular strategy that we run in low volatility, we saw that it does well in India, right? In India, it has been a good performance. It has given low drawdowns, and it is a good strategy to run. But yeah, obviously, India inherently has a much higher risk compared to the global market, right? And a little bit more uncertainty compared to the global market. So, I mean, I think, the low volatility stocks will do much better than high volatility stocks. The spread will be much larger for developed market, right? Whereas in India, obviously, you will also see that spread, right? So I think, we need to evaluate it. I don't have an exact answer really, but I think we have to evaluate.
Right. Have you also done some work on whether a low volatility factor may work well on an absolute basis or may work well if you construct it in a more sector aware manner? Meaning,
so I think, I know. Yeah, I understand. So I think the factors like momentum and low volatility, right? Those sort of have to be sector agnostic, right? You don't have to, pick the lowest volatility stock in a particular sector. You just look at the whole universe. But when you're looking at like a sector, like a factor like value, right, or growth, you have to go for sectors, right? Because otherwise, a particular sector itself will always be, undervalued,
right,
or overvalued, right? So I think low volatility, it will also you will see the, your allocations will shift, the sectors will shift, right, within the low volatility space also, right? There might be times when, probably FMCG will not be the most low volatility sector. You will see other sectors also getting representation, right? Maybe IT overtakes it or things like that, right? So it has to be like these factors have to be totally agnostic.
Do you think there is any merit in using all the components of the Nifty 500 and then running the strategy as opposed to running it only on the large cap or the large and mid cap space?
I mean, for this, but I mean, I obviously, expanding your universe will obviously, it always helps, add more flavor to a quant strategy. For this particular factor, I think, if you are focusing only on, I mean, I think even if you increase the universe, the stock that you will pick will be the large cap stock, right? Because typically mid caps tend to have high volatility compared to large caps, right? So it will be interesting to see. I mean, the version that we run at our end sort of has the broader universe, right? We include, I think, 300 stocks, not 500, but we include 300 stocks. So obviously, we saw a bigger spread for our strategy compared to the index, which is because I think we include the broader universe, right? And we are doing much frequent rebalancing.
Right. So in your presentation, you did show the sectoral breakdown, but any sense on the market capitalization breakdown? Is it in line with the benchmark, or do you think you actually get more? And I'm talking about your methodology. You actually get more mid-cap names in there?
So I think we could have mid-cap names in our case because, we try to, because we use a portfolio optimization method, right? Where we are trying to increase the diversification in the portfolio also, right?
Right.
So when you use portfolio optimization, then you will tend to have a diverse set of things, right? So you might see that actually a mid-cap might be included in this, whereas with the Nifty methodology, where they're just ranking and picking the top ones, they will tend to have the more large caps, right? So in our methodology, we might have more smaller stocks, might have some smaller stocks because of the diversification that we're going for, right?
Right. Maybe you want, for everyone's benefit, maybe you want to explain a bit more on how diversification also helps reduce portfolio volatility.
No, definitely. So so we talked about, even in the low volatility context, that the low volatility strategy itself is uncorrelated to a lot of strategies, right? So if you include a low volatility strategy along with, whatever allocation to momentum or Nifty you might have in your particular portfolio, you will see that adding a low volatility strategy to it has enhanced your portfolio performance, because, wherever your momentum portfolio goes up, low volatility might go up slower, but when your low momentum portfolio is down, then low volatility is slightly up. So your overall portfolio drawdown or loss is averaged up, right? So you have done better than what you would have done when you had a single factor, right? So obviously, including diverse set of factors that move in a different way, right? That don't move together always helps, because when a factor like momentum is going down, then your low volatility is going to support it, and vice versa.
Right. I think last question is, so all these things look very good, but are there any obvious risks to the low volatility strategy, or is it the elixir that we have all been looking for?
No, I think there are, obviously it's not an elixir, I will not say that. I think, we have to sort of watch this low volatility strategy in an environment where the rates are rising, right? Because, we have seen low volatility perform really well in that environment where, bond rates, where they have consistently gone down. So now, like we said, that recently FMCG is having some trouble, which is a huge percentage of the low volatility strategy and things like that, right? So we have to be careful, and it's not an elixir, when all of us realize that the volatility works, it will get arbitraged away, right? So like any factor, it has various nuances to it. It is a persistent factor, that has history, that has, decades of outperformance, and it's a very interesting thing. But as investors, we always have to be watchful, and we always have to evaluate things before we, call it.
Right. Great. Thanks a lot, Sonam, for the wonderful presentation once again, and also taking time to answer all our questions very, very diligently and patiently.
So thanks a lot for having me.
Great.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.